In March 2026, a sharp shock hit the Indian stock market. The Nifty index took a steep dive, shaking investor confidence and erasing weeks of steady gains in a matter of days. Traders are actively pricing in more chaos. The India VIX, a metric that measures expected market volatility and fear, spiked near 26.80. The primary drivers of this fear are happening well outside India's borders. Rising geopolitical tensions in West Asia pushed crude oil prices past $100 a barrel, threatening to inflate costs across the economy. Behind the scenes, there is a massive institutional tug-of-war. Foreign investors are aggressively selling off their positions to reduce risk, while domestic institutions are quietly stepping in to buy up the supply. This dynamic forces a critical question. Are we witnessing the early stages of a deeper market crash? Or is this the ultimate buying opportunity disguised by global noise? Many retail investors assume a market bottom is a specific price, the absolute lowest number during a panic. A true bottom is a behavioral process. Selling pressure exhausts, forming a rounded floor. Applying this to Nifty's March 2026 trajectory, buyers are successfully defending the 22,900 range, establishing an initial floor. To confirm a durable bottom, the index must break the 23,500 resistance ceiling. Furthermore, the volatility metrics we looked at earlier remain elevated. The fear hasn't fully drained from the system. Technically, Nifty is hovering inside a bottoming zone rather than a freefall. The support is holding, but the market awaits definitive proof that buyers are back in control. To understand if that technical floor will hold, we have to step away from the daily charts and look at India's foundational macroeconomic health. First, Nifty's price-to-earnings ratio, measuring how expensive stocks are, is sitting at roughly 19.97. The market is trading at a fair valuation, not a bloated extreme. Second, domestic consumer inflation remains tightly controlled at 3.21. This scatter plot maps out the FY26 index targets from heavyweights like Citi, Nomura, Goldman Sachs, and BofA. You can see they all cluster tightly between 28,500 and 29,300. The exact tone of these projections is highly constructive. The analysts see solid upside, but they are deliberately avoiding the word euphoric. Practically, this means investors should adjust their expectations. The data does not point to an explosive runaway rally. Instead, expect a calculated, methodical climb. As foreign capital flows stabilize and global shocks are absorbed, the market is positioned to grind steadily higher. The strategy is simple. Ignore the short-term global noise. Watch for the index to break that 23,500 resistance line and trust the undeniable momentum of India's domestic growth. Please note this video is for educational purposes only. Investing in securities markets is subject to market risks. Read all related documents carefully before investing.